Salesforce, Amgen, and Honeywell take the place of ExxonMobil, Pfizer, and Raytheon. What's that mean? 3 stocks coming out of the Dow, 3 brand new stocks coming into the Dow. Looking at what the market did in the month of August, you would think that we were in the best economic time in your life. Things have been off the charts. Join me for this month's monthly economic update where I can dive in and take you through some details and see what's really happening. One of the first things that I want you to do is check out our website for an article that my brother Shane wrote on COVID-19 and its effects on real estate. One of the biggest questions is, what is the effect of COVID-19 going to be on commercial real estate? And it's going to leak into the apartment buildings, it's going to leak into the inner cities and to the suburbs. Read this article. It's all about COVID-19 and the real estate market. Right now, you've got home prices on a tear. Why is that? Well, because we've got so many people that are saying, I want out of the apartment buildings, I want to get out to the suburbs, and we've got ultra low interest rates right now that are allowing people to purchase homes at much lower monthly payments. I believe that we are at the beginning edges of seeing that individual housing market do extremely well and remain very, very strong for at least the next 5 to 7 years as the millennial generation gets out buying houses and having babies. That being said, the commercial real estate market doesn't look so good. We're going to dive into that here in just a minute. Also want to mention that we have unemployment now down to 10.2%. It looks like we got jobs continuing to come back slowly. Looks like the economy is doing a little bit better. I don't know that the economy, the way that it's running today, really tells the whole story behind why stocks are doing what they're doing. If you missed last month's economic update, you need to go back and watch that again. Bud Casper and I talk about the reasons that we think the market are on a tear. Number one, there really is no place else to put money. And number two, you don't fight the Fed. And the Federal Reserve has made it very, very clear that they are here to be a backstop for the economy and to provide liquidity to any markets that may need them. So let's take a quick look at the month of August. As we're recording this, it is August 26th. Here's where we're at. So far in the last month, we've got the NASDAQ, top of the charts again here, up 10.04%, and it's green across the board. The S&P 500 up 5.84, the Dow Jones Industrial Average up 6.45, the S&P 100 up 7.75. Down at the bottom, you've got the S&P mid-cap. Let's back out from that monthly view though, and let's take a look at a year-to-date view of this. If I click the year-to-date chart here, what you're going to see here was March. That was the big COVID sell-off. The NASDAQ has recovered unbelievably. Look at the spread here, 34.45% positive on the NASDAQ so far this year. S&P 100 up about 11.5. The S&P 500 up 6.92 now. And the Russell 3000 up 6.49. You still got the Dow Jones Industrial Average a little bit in negative territory. Russell 2000, small and mid cap, all in negative territory. We've got about a 55% spread between the S&P small cap and the NASDAQ, a huge spread. But I want to dive in and take a little bit closer look. What's happening is you're seeing money flow to technology stocks starting all the way back in April. Technology has been at the top of the heap of where the money's going. And anytime money continues to flow into one certain area of the market, it's going to continue to push those prices up. And that's what we're seeing. Why? Well, we all know how important technology has become in this COVID-19 environment. And so any company that's out there with technology in their name or is doing something, making it easier for people to communicate and do things from home, remote work, etc., we're seeing those stock prices soar. Apple stock is absolutely on a tear this year, announced a 4-for-1 stock split. That's going to make a big difference. Let's dive into the subsectors here. And I'm not going to chart this. I'm just going to go on a year to date. I want to sort this out here year to date and just kind of look at the disparity between where the returns are actually coming from. So You've got Innovative Technology ETF. Look at that, up 46.32% so far this year. You've got the NYSE Technology ETF up 44.96. Let's kind of look at home builders. Home builders is doing great, up 18.74. Now, commercial real estate, on the other hand, gotta scroll down here. Commercial real estate, on the other hand, is kind of on the other side of this. Let's see, healthcare, pharmaceuticals, you would think that would be up, but it's still down 4% year to date. Transportation down 7% year to date. Aerospace down 16%. Here's mining, here's insurance. Dow Jones REIT Index right here. The Dow Jones REIT Index, look at that, negative 20.8. While we've got the home builders index up 15%. So a big disparity. That's what we were talking about earlier on there, was the difference between what's going on in residential real estate and what's going on in commercial real estate. So make sure you read that article that my brother wrote. What's our worst performing subsector out of the markets right now? It's down here. Oil and gas equipment and oil and gas exploration down 43.5% and almost 56% respectively. Regional banks down 32%. Still a fear of defaults from COVID and the lack of the additional stimulus bill being signed. Not really sure when businesses are going to be able to fully open back up, when the consumer is going to get back out there and continue to spend. So that's putting pressure there. Insurance companies struggling, mining struggling, aerospace struggling. So this is not, as Bud and I talked last month, this is not a broad-based rally where we're seeing the rising tide lifting all boats. There are subsectors of the market today that are still getting beat up and have lost a lot of money this year. So we're keeping an eye on that. We want a little broader breadth of really what's happening in the overall markets. Right now, you're seeing most of the money flow to technology, like I said a minute ago. We got a big event coming up here in a couple of months. We've got an election. There are a lot of questions around how will the outcome of the election impact the markets. I've got a lot of theories about that, but I don't want to make this a political discussion. The bottom line is that I do believe that the markets would react favorably with a Trump victory. I believe that the markets would throw a little bit of a temper tantrum early on with a Biden victory. However, you can look back in the past and look at Democratic presidents versus Republican presidents. The markets really don't care, because what the markets really care about is consumer spending, because consumer spending represents 70% of our total gross domestic product. The key to a continued market recovery and a continued economic recovery is going to be getting the American people back to work and back to spending. That's the key. Getting us back to some sort of normalcy. And of course, what we're talking about there is what is the outcome of COVID-19? That is a really big thing that's up in the air. But those are the two biggest things that could negatively impact the markets between now and the end of the year: COVID-19 or the presidential election. We'll continue to keep our eye on everything for you. And as always, we encourage you, stay in touch with us. Make sure that you're contacting us, talking to us about the makeup of your portfolio, looking at where you're at on your overall financial plan. If you're not a client yet of Barber Financial Group, we'd love to start a conversation with you and talk to you about how we can help you live your one best financial life. Thanks for joining me, and I'll talk to you next month. All of our YouTube viewers, please subscribe to our channel and give us a thumbs up.